Welcome to the Ag Commodity Corner Plus podcast. It is December 12th, 2025, week number 38. Welcome.
Hey, everybody.
Thanks for watching. Don't forget to subscribe to the channel. Let's get right into it with our weekly summary quote chart. And I've highlighted a bunch of stuff that was happening this week. We did not end the week well. It felt like a macro risk-off day, because the tech stocks were being sold in the stock market. That may have had some spillover effect into the ags. Soybeans down 29 cents, closed at, I'm still using, I believe, the January contract at 10.76 3/4. That one's going to come to an end soon, so we'll be talking more of the March contract going forward. But that's hitting that 1080 support. One day does not make a trend. 1 week does not make a trend. So we'll see what happens next week. But we need China to come to the rescue. Where are your millions of metric tons of beans that you like to buy as a goodwill gesture towards a trade deal? That's what we need. We need one. We're missing zeros in front of these flash sales. Canola down 12. To 605. That 605 is a major support. That needs to hold into next week. I feel like we're already into holiday trading because the volumes are drying up, but doesn't mean that markets can not move lower. I think the funds are in that end of quarter, end of month, end of year fund liquidation mode, and that may continue over the next couple of weeks. Hogs bouncing, that V-shaped bottom continues. We're hearing health herd problems in the Midwest, particularly PRRS. We warned about this, that as you get into the winter, those diseases could ramp up again, and I think that's what's happening. Cattle continue to ride that higher cash strong market, although feeders did slightly gain on the week. Down to new records, as I said earlier, because we're rotating out of some of those tech stocks into some value plays. The S&P and the NASDAQ. The S&P almost hit 7,000. The NASDAQ has come off a little bit. Bitcoin looks like a new trading range. We talked about this the last couple weeks. 96,000 at the high end ceiling. The support in that 80 to 82,000. Crude almost a new low. That's good for your inputs. Farmers, are you watching? Are you listening? Inputs into the first quarter, particularly diesel, will get cheaper. So be prepared to book some diesel fuel moving forward. But the low is 56.85. So I think we could, unless we get into some geopolitical risk premiums next week, we could see a new low. There's a glut of production. I'm not going to bring up the chart in this podcast. Maybe I'll do it next time. But production is higher than most years, not quite as high as March of 2020 when we shut down the global economy. That was a black swan. We're not into a black swan, but we're probably second to a black swan, and that's going to continue to weigh. And then natural gas prices have just plunged 30% in just 5 days. We'll get into that. Silver, new record highs. We'll get into that as well. And we had some movement in the currencies this week, particularly the Canadian dollar surged. That U.S. dollar's breaking lower. And because of that, the euro dollar also rose. So let's get right into it. Let's start off with that December USDA dud.
The USDA 2025 December WAS day did not hold a lot of surprises. Most of it was expected. As expected, they did not tinker with the supply side of the equation. But on the demand side, there was a remarkable increase of about 125 million bushels of U.S. corn exports projection, taking it to 3.2 billion, which is a huge record. And this resulted in lower ending stocks for corn. So on the whole, the report was friendly corn. It was neutral soybeans and neutral to bearish wheat futures. The new export figure for corn at 3.2 is higher year on year by 12%. But as far as the pace of exports is concerned, that is even higher at 30%, which is the real export pace that is happening at the moment. USDA left soybeans and all wheat ending stocks largely unchanged. And on the global side of the equation, we had wheat, which came in near the top end of expectations. No changes were reported for the 25-26 China soybean, corn, and wheat imports. No surprises as far as the Brazilian and Argentine corn and soybean output was concerned.
So this report was a kick the can down the road on supply side for the U.S. side. As Abhinash mentioned, the U.S. corn export pace was increased. This is the fourth consecutive month. My thoughts regarding that is they probably have done that, and it surprised some, because they're looking to lower the yield in the January crop report. Now, some will say, and many are thinking, that we can't drop ending stocks on corn below 2 billion, which is this number here, but we disagree. Why? Because many are concerned that the USDA is too high on feed and residual. The feed and residual component of the corn balance sheet for 25-26 is at 6.1 billion. It's much higher than last year. They're looking for that similar amount next year as well. But feed, yes, is probably slightly lower because we're not importing that 100,000 cattle from Mexico into the U.S. It's about 100,000 per month for the last 8 months. 100,000 animals use up about 1 million bushels of corn per month. So are we maybe too high by 8 million? That's a very small number. It's the residual component of that feed and residual that is very difficult to track and forecast. The USDA has a very difficult time doing it. So do private estimates and analysts. And I think because the U.S. crop this year is record strong, because of those acres, those record acres, or not large acres, even though the yield may come down a little bit, I do not think that the USDA has to adjust that lower. If they do not, with ethanol running about what the USDA target is, you could see ending stocks drop to 1.4 to 1.6 billion bushels with a 4 to 6 bushel drop in yield. And that's bullish corn into the first quarter of 2026.
We had the long-term projections, which were reported by USDA. This is an early release of what they would release later next year in Feb. The 26-27 baseline projections forecast U.S. farmers will plant about 95 million acres of corn, which is down 3.7 from 98.7 in the prior year. And as far as soybeans are concerned, farmers expected to plant 85 million acres. All wheat acreage coming in at 44 million, which is off by about 1.3 from the prior year. And still not, and that reduction in wheat acreage is still not enough to support futures. The current new crop U.S. soybeans to corn ratio is at 2.373, which still favors corn acres more.
Yeah, so just to go back to the corn balance sheet, for this is 26-27. We don't disagree with that 95 number, which is right up in here. Some of these numbers are too small, but nonetheless, for now, it looks like more corn acres. If you look at the economics, the U.S. farmer can still make a little bit of money on the corn versus beans. You need the bean price to really start trading back above 12, maybe get into the beans in the teens type scenario for you to attract a lot more acres to beans. It's still too early. We need that Chinese demand to show up. We'll see if it does show up eventually. Remember, that Chinese demand can take some time. In 2020, when we signed that phase one trade deal, it took a few months. So we're almost past that few months. So let's see what happens here. The export forecast is 3 billion. We're currently at 3.2. So the USDA is a little bit lower on exports for next year, but still quite high. So a yield of 182 trend line, that makes sense, and 2 billion makes sense on ending stocks. For the soybean balance sheet, ending stocks at 314 makes sense. The acres make sense for now, and exports at 1.715. That's even higher than this year. So China, I'm assuming the USDA assumes that China's going to come through, not only for this year, but also next year. Remember, next year, they're expected to buy that 25 million metric tons. And in 2024, China bought about 24 million metric tons.
And we also had another update to the weekly exports release from the USDA. Again, corn, that chart there shows just how strong the corn export program has been. But more importantly, Mexico was the number one buyer of U.S. corn, soybeans, wheat, and pork. What would the U.S. do without Mexico? It was another stellar week as far as exports were concerned. In terms of numbers, Mexico just for the week bought 767,000 metric tons of corn, soybeans at 86,500, wheat at 74,100, pork at 7,600.
Yeah, for now, Mexico is beating China at buying those U.S. soybeans. But I'm going to assume by the time we get to 26, China will be the number one buyer again.
Also, the much-awaited farm aid package was unveiled by Trump. So that amounts to, as expected, $12 billion US dollars. Most of the money, $11 billion, is earmarked for one-time payments to farmers for row crops, as part of the Ag Department's Farmer Bridge Assistance Program, with another $1 billion reserved for crops not covered by the program. And this is all in response to the hardships that farmers are facing due to the trade wars.
This helps no one. This helps no one long term. It helps the ag banks, the fertilizer companies, seed, it's sad because Trump doesn't even know that E15 is a big thing. So, like, who is his advisor? So this is so frustrating. You know, if they could figure out more U.S. domestic demand, like E15, and drive prices to $6 corn, maybe the price is good enough to cover those higher inputs instead of trying to fix those inputs and slapping tariffs on Canadian potash. How is that going to fix anything? Last time I checked, I didn't know that the U.S. had potash mines everywhere. This is not going to produce more fertilizer in the United States. He does not understand that takes years. Maybe you should fix those countervailing duties on Russian exports of fertilizer. Maybe resolve that peace deal with Ukraine, Russia. Maybe do a trade deal with Russia. Maybe fix fertilizer exports from China since you just signed a trade truce. I don't know. I give up.
Also, taking a look at where that export program, as far as soybeans are concerned, to China, and that big trade truce that had been agreed upon. Our China soybean purchase tracker currently is at 37.7 and amounting to 4.521 of the 12 million that was promised. And we've been getting daily export announcements by the USDA, which is good news, but still a long way to go more.
Some think that we're up to 6 to 7 million metric tons. Some even think that China was going long futures to offset the physical purchase. The daily flash sales amounted to 4.5. Out of that 4.5, 912,000 is unknown. We include the unknown because we think that unknown is China. If it's not China, it's South Korea backdoored into China. Come on. In the past, we all agreed it was China. All of a sudden, it's not China? Come on. Again, very frustrating. Why can't we just be transparent with farmers? Period. That's all I got to say. By the way, I think China's pace will pick up. Remember, give it a couple months. I know we're impatient. We waited a year and a half. We finally got something. By the way, we called the bottom in one commodity this week. So join the program and find out what that commodity was. It's important to your bottom line. Check out the program.
And going into the energy markets, quite a remarkable move in natural gas. So after rising through the prior few weeks, we see that on the chart, that steep downward correction. After surging to, in fact, contract highs, U.S. natural gas plunged by over 30% in just 5 trading days. Higher demand and the frigid weather, which is expected, and we are seeing a lot of it these days, seems to already be baked into futures more.
Yeah, this is common. You literally, as a speculator, you can go long natural gas around August. Where's August on this chart? So, somewhere in here, okay, right near that bottom. And you can almost guarantee yourself a profit every year. Sometimes it's early, sometimes it's later. This year felt like it was January already because we had those frigid temperatures early. We had lots of moisture, and all of a sudden the market baked in a lot of that demand. But sometimes the market can taketh away very quickly, and that's what happened. Sometimes it doesn't last, and all you need is just a little bit of a warm forecast, which they're calling for here in about a week's time. And you got the funds liquidating and taking some profits. So I think the $4 is your support, but it can go as low as 3 to 2 some years. But and this high here at 5.5 can actually approach 7.5, and actually $10. But I'm not sure that that's going to happen this year. But it's still a big winter ahead of us.
Let's look at that safe haven trade that's been gaining momentum, and as you guys can see there on the chart, a steep spike in prices in recent days and weeks. As far as silver is concerned, silver traded to new record highs as the debasement and de-dollarization trade continued. But technicals remain overbought near term, as you can see there at the bottom, the overbought RSI indicator going into overbought territory. Thanks to countries buying more safe haven assets like silver, gold, and the other precious metals versus the US dollar, futures have had to ration demand with higher prices.
This is a sell to us. You could start a bear market in silver, but we've taught you this many times before. When the market trades parabolic, 90 degrees to the top side, well above the 200 with an RSI at 84, which is very rare, folks. You rarely get an RSI above 70, let alone at 84. I don't know if I've ever seen 100, but I'm assuming because the index does go to 100, you could. Never say never, but buyer beware. I would not be long silver. If you are and you got lucky and this trade, this haven debasement deal dollarization trade continues. It's countries buying gold and silver, period. So like China, adding to reserves while subtracting away from that US dollar currency. As long as they continue to do that, you have a finite supply of silver that tarnishes, gold does not. And I think eventually this has to come back to earth, so just be careful.
Let's also look at the soybean futures daily chart, and this is the Jan soybean futures. Soybean futures remain in correction mode after the funds went near record long soybean futures contracts on November the 18th, closer to that 229, 625 in terms of number of contracts, but support at 10.8 should hold into the year end when fund profit taking liquidation comes to an end. And it is end of the month, end of the year, and end of the quarter as well.
Guys, remember you were sitting at 1080 as a ceiling for 1.5 years. You traded to a low of about 980 to about 1080. And we were waiting for that China-US trade deal. We got a truce. I don't know if we have a trade deal. I haven't seen anything signed yet. So I think in technical terms, irregardless of the headlines, I think we're beyond the Chinese headlines, the flash sales, the expectations. I think it's going to happen because China wants to appease Trump and the trade deal in the next 3 years and all that fun stuff. So it's politics. But I think the 1080 old ceiling becomes your new support. So as long as the funds are done selling, and by the way, while we were in the dark and the U.S. government shut down, you can blame Trump for this one. I'm sorry, but I got to blame somebody because he could have reopened the government sooner. But at this high, the latest CFTC report as of today, November 18th, showed that the funds were long 229,625, just shy of the record long position in 2020 at 232,000 and change. If I knew that that's how long they were, and you could surmise that they were buying. You knew they were long. You just didn't know how long. I think they were assuming that record strong Chinese demand would show up. It's shown up, but it's not record strong yet. And I don't know if it's going to be record strong because that's not what they've signed up to. But if you believe the team at the Trump administration, it's a floor. So maybe we could see record amounts. I wish we would have just re-signed a phase 2 trade deal and had more details. But nonetheless, I think this should hold into year end, and then we can resume the uptrend, and the next leg would put you at 12 to 12.25.
This week was big not just because of the WAS day, but also the much-awaited December U.S. Fed FOMC, and as expected, the U.S. Fed did cut rates for a third time this year by the expected 25 basis points. So currently the range for the U.S. central rates are at 3.5 to 3.75%. But the text rather was that they will only cut one more time in 2026 and once more in 2027. But the big question is, when Powell is not the Fed chair and we have his replacement coming expected in next April, are they willing to cut rates aggressively? And if so, are we headed towards that 2% target range, which could be very bullish for ag and stocks? And it could also reignite inflation as we go into 2027.
Powell was hawkish for 26 and 27, but you got to go beyond his term. Who's the next guy? What is he planning on doing? Trump is going to select that new guy. I forget his name, but he's expected to lower rates more aggressively than Powell. So you got to go beyond the first part of 26. And as long as we do continue to cut rates, and as long as the economic data allows for it, then that's bullish stocks. PEs will expand, and it could reignite inflation. And if you go back to 2022 when inflation peaked, what did grain prices do? They also peaked, much higher prices than where they are today. So we'll have to wait and see. But inflation takes a long time to play out.
I believe more as of today's headlines from CNBC, the name of that person is Kevin Walsh, who's the top candidate as far as Trump is concerned. Let's look at South American weather. After 2 months of being drier than normal in Brazil, the rains have finally arrived for the first half of December, and a record crop is still in the cards. But if this pattern continues and verifies, it could start to delay the harvest. Argentina, after being too wet, has turned dry, but they are small in terms of production numbers compared to Brazil in the grand scheme of things.
Yeah, so I've circled that area in that southern Brazil. They're expected to get another 4 to 6 inches. We were very dry in the last couple months. It was less than ideal, but it didn't impact planting. And all of a sudden, the rains are showing up. And this could become a problem if it continues, because all of a sudden now it could delay harvest. So we'll have to wait and see how this plays out. But for now, it's a 175 to 176. Some were calling for 180, so it is down slightly from the start, but it's still higher than last year, so it's still a record. So unfortunately, we're not going to get, so far we haven't gotten that South American weather scare, but we're not out of the woods. We can get that in January. For now, the funds could be removing more of this South American weather scare premium than a premium because of less than desired demand from China. And you can see here as you get into that third week of December, you've got plenty of rain for both central and northern Brazil as well.
And looking, and as you mentioned earlier when we started the podcast, you mentioned the Canadian dollar. The surge in the Canadian dollar after better than expected economic data, including higher employment numbers and that third quarter GDP at 2.6% growth, that could be short-lived. March Canadian dollar is up about 2.44% since the second half of November and currently at 0.729 versus the US dollar.
Yeah, so there's a tailwind because of that lower U.S. dollar we talked about, but you also had some tailwinds because of better economic data. I thought we were struggling. This was a surprise to me. I think it caught a lot of people off guard. One of the reasons why the Bank of Canada on Wednesday this past week did not touch interest rates. We've been a little bit more aggressive on cutting interest rates than the United States. So I think we've cut about 9 or 10 times, whereas the U.S. has cut about 3 times. So the U.S. has a lot to catch up to us, but maybe those lower interest rates are starting to help the Canadian economy. But you can see the triple bottom breaking above the ceiling at 72, the resistance, and then breaking above the 200. So you've got some bullish indicators here that could take you back up to this high here way back in June. So we'll have to wait and see whether it is short-lived or not. But this could weigh on basis for Canadian farmers into 26.
And this one's fresh off the press. So today's announcement by CFTC on the net managed money position, albeit it is still delayed. So the data is as of November the 18th. As you guys can see, a lot of buying there in ag. So in corn, they bought about, the spec funds bought about 77,650, taking the net position to net long, flipping it to net long. So corn's at 38,127. The big one there, soybeans, so they bought 35,182 and took it to near record territory at 229,625 as of November the 18th, and more buying in wheat and canola as well.
I got to think the next report is going to show that they were selling beans, because on November 19th is when the beans peaked. So we'll see. This report can be a 2-week lagging report, so maybe they kept buying and we won't find out that they started selling until the end of the year type of thing. So they did reduce some of their wheat short positions, but guys, we've talked about the potential for a Christmas rally. Boy, I think the Bears are going to win both Thanksgiving and Christmas. It does not look good heading into Christmas. The markets are just particularly the ag commodities are simply rolling over here. So maybe we'll have a better week next week. By the way, breaking news: biofuel industry sources cited by Reuters on Friday said the Trump administration will likely be unable to finalize 2026 blending mandates by the end of 25. Surprise, surprise. This is not good, and that's another one of those reasons why I don't think you're going to get that Christmas rally. Hats off to our Western Canadian friends. Please keep it west. You're getting that Alberta Clipper, minus 40 to 50 degrees with wind chills this weekend. You can keep it. Thank you. Have a great weekend. We'll see you next week. We got one more podcast before the end of the year, and then we're gone. We're done for the year. So once again, thanks for watching or listening. Really appreciate it. Have a great weekend. Take care. Bye for now.
Bye, guys.